what we can currently see is price took out the previous year high, displacing below the previous year high candle, which is number one, a previous cycle high, as well as a bullish breaker. Price is placed below it on this candle here, producing a change in the state of delivery, meaning now, currently, the daily time frame is in a sell program. And because you've taken out a previous year high, I anticipate some form of sell side delivery into where? Well, this is the November low, and this is the November high, meaning as soon as the first day of December opens, which will be on the next candle here, which will be tomorrow on Monday, this will be the previous month's range. What's important to understand is either the previous month high will be reached first, or the previous month low will be reached first. Meaning, either we're going to see a market maker sell model unfold, or we're going to see a market maker buy model unfold, where price delivers sell sides and then delivers buy sides. And so knowing that, I just need to figure out, okay, is November high the draw, or is November low the draw? Because if I know which one is the draw liquidity, then I've got a draw liquidity for a week, maybe even 2 weeks. And so I can just trade in line with that draw liquidity, trading expansions on, for example, the hourly time frame to frame fractal market maker sell models or market maker buy models. And so as of right now, is November high or November low the draw liquidity? I do not know. However, what I do know is price is likely to reach into this imbalance here, which is at a discount of the current monthly range. So this imbalance here is my current drawn liquidity, which is at a discount of the previous month's range. The daily time frame is in a sell program. What would invalidate the sell program, or what we can see is that price formed a bearish breaker, where we have a high, low, higher high, lower low. And so as long as price remains below this bearish breaker, price remains in a sell program, meaning as long as price remains below this breaker, this imbalances the drawn liquidity. How price trades this imbalance will determine if November low is the drawn liquidity. However, if price displaces above this bearish breaker, then that would confirm that November high is the drawn liquidity. And so the game plan right now is very simple. Wait to see how price will trade, firstly at this imbalance here and this bearish breaker, because as of right now, we've taken out a major liquidity pool being the previous year high. And so we could see November low be traded to, but also we could see a continuation of order flow because we still do have buy side targets that haven't been reached. And so for now, it's just a matter of being patient and waiting to see what this week will deliver, remaining objective and just remaining patient. If we now go down to the hourly time frame, what I said in the previous outlook was as long as price remained below the previous week low, which is this candle here, which is also bearish breaker, then order flow remained bearish. But what I also saw was we had this bullish Vivaldi gap here that formed on the left side of the curve, which has been utilized as support on price here. And so this imbalance is of significance because it's actively being utilized as support on price in the past. And so once it's placed below, we anticipate it being utilized as resistance. And so as of right now, draws on liquidity are lower. Nothing has formed yet for me to move my invalidation level. If price is placed below this bullish order block, then that would become my invalidation level for the current sell program. But for now, draws on liquidity are lower. Invalidation is this bearish breaker. What we can see is that price has retraced into that imbalance, which is the invalidation for the current sell program on the hourly time frame, meaning any move high is a retracement, which should be followed by an expansion lower into our drawn liquidity, which is this imbalance here. If price, however, displaced above this imbalance, that would initiate a buy program, and I would want to see a high formation inside of this price range here, which is of course that daily bearish breaker. And so for now, as long as price remains below this imbalance, I anticipate this blue box, which is that daily bullish Vivaldi gap being reached, which is my current drawn liquidity. What we can currently see is, as of right now, price remains in a sell program. Reason being is we took out the previous year high and then displaced below it, which was the previous year high candle. We then displaced below these bullish order blocks, forming a bearish breaker. And so for now, the daily time frame is in a sell program. And so the scenarios I'm looking for is very simple. My current drawn liquidity is this bullish Vivaldi gap. Why? Well, if we take the November range, this is the November low, this is the November high. And as we can see, this imbalance is the first array, which is at a discount. And so this is the current drawn liquidity. What would invalidate this drawn liquidity is if price is placed above this bearish breaker. If price is placed above the bearish breaker, we're no longer in a sell program and we're now in a buy program. And so November high will be the drawn liquidity. If we now go down to the hourly time frame, what I said in the previous outlook was as long as price remained below this imbalance here, which was being utilized as support and resistance, then the drawn liquidity was lower. However, as we can see, price displaced above that array. And then what I said in the Telegram group was price displaced above the IFVG, which is this price range here. That was the invalidation for bearish institutional order flow. The game plan is very simple. If price utilizes this IFVG as support, I anticipate price reaching a premium of the current weekly range, this being the previous week high, this being the previous week low. And so this imbalance was at a premium. As you can see, this is the imbalance here. I anticipate price reaching a premium of the current weekly range. From there, we will assess whether we are likely to draw towards the previous week high or the previous week low. And so what we can see is price did in fact utilize this inverse Vivaldi gap as support on price and then expanded higher into the drawn liquidity, being that premium Vivaldi gap. Now the game plan right now is very simple. If the previous week high is the draw and November high, what I want to see is displacement above this premium SIBI. Why? Well, because if this is a market maker sell model, then price should form a high at a premium of the range. However, if this is a market maker buy model, then price needs to displace above internal range liquidity of the premium range. And so the game plan is very simple. Either price will displace above this imbalance, validating previous week high and November high as the drawn liquidity, or price will displace back below this imbalance, utilize it as resistance, which will confirm previous week low, and this imbalance as the drawn liquidity. And so in other words, as long as we remain within the range of this imbalance and this imbalance, I'm neutral. And so what I'm waiting for is either displacement above the imbalance, utilize as support, or displacement below the imbalance, utilize as resistance. Very simple game plan. What we can see is DXY took out the previous year high, failed to utilize as support, and instead displaced lower below these bullish order blocks, forming bearish breakers. And so for now, the daily time frame is in a sell program. Do we have a drawn liquidity? Yes. Well, if we take the November range from high to low, what we can see is this imbalance, which is at a discount of the range. What we could see is price retrace into internal range liquidity of the November range, being this imbalance, and then how price trades here will determine if we're going to reach the November high or the November low. What would invalidate this drawn liquidity, this internal range liquidity target, is if price is placed back above this bearish breaker. Meaning, if price is placed above this breaker, this would validate November high as the draw. And so for now, as long as we remain below this bearish breaker, this imbalance is the current drawn liquidity. So if we now go down to the hourly time frame, what I said in the previous outlook was as long as price remained within the range of this imbalance, which is at a premium of the previous week's range, and this imbalance here, which is a bullish Vivaldi gap, which was displaced through on the left side of the curve within this potential market maker sell model. As long as we remain within this price range, we anticipate the consolidation to continue. And what we can see is that price went from discount to premium to discount to premium to discount. And so notice how we anticipated this consolidation well in advance, because we said, okay, as long as price remains within this range, we anticipate price to continue the consolidation. And this is exactly what we can see. And so the game plan is very simple. If price is placed above this imbalance, this would validate the previous week high as the drawn liquidity, and then how price trades there will determine if November high is the draw. Or if price is placed below this imbalance, utilize as resistance, that validates previous week low, and that imbalance on the daily time frame as the drawn liquidity. And so the scenarios I've laid out are very simple, very objective. There's no discretion there. And so those are scenarios I'll be monitoring for NFP. So what we can now see on the daily time frame is price has now reached our drawn liquidity, which was this imbalance. Why was this imbalance our drawn liquidity? Remember, price took out the previous year high and then failed to utilize it as support, meaning price initiated a sell program. And so because we were in a sell program, we need to identify a sell side target. Now, if we take the November range from high to low, what we can see is this imbalance was at a discount of the range. And so as long as price remains below this bearish breaker, I anticipated this imbalance being reached. And what we can see, price retraced into the midpoints of that bullish order block, which became a bearish breaker, utilized it as perfect resistance, and then expanded into our drawn liquidity. This was a market maker sell model on the lower time frame. Why? Well, if order flow is bearish, price will expand lower, retrace higher, and expand lower. Every single higher time frame reversal, as well as a retracement followed by expansion, is a lower time frame market maker model. For example, this reversal here, we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. This retracement higher followed by expansion lower, we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. If you don't believe me, then I'm going to prove it to you. So this is that reversal on the daily time frame. And if we go down to the hourly time frame, what we're going to see is that reversal here. And we've got original consolidation, left side of the curve, smart money reversal, right side of the curve. So I've just proven to you that every single higher time frame reversal is a lower time frame market maker model. In this case, market maker sell model. Now this retracement higher followed by expansion lower is a lower time frame market maker sell model. Just to prove it to you, this is the hourly time frame, original consolidation, left side of the curve, smart money reversal, right side of the curve. So I've just proven to you that on any time frame, we can frame lower time frame market maker models, because every higher time frame reversal is a lower time frame market maker model, and every higher time frame retracement followed by expansion is a lower time frame market maker model. This is the beauty of understanding how the algorithm operates. You can trade any time frame on any market over and over again. What I said in the previous outlook was what I was looking for was either displacement above this SIBI, utilize it as support, confirming that previous week high was the draw and November high, or displacement below this bullish fair value gap, which would become an inverse fair value gap, utilize it as resistance to expand lower into our drawn liquidity. And what we can see is the price displaced below the imbalance, utilized it as perfect resistance, and then expanded lower into our drawn liquidity. Notice how all week we anticipated from here the price would consolidate within these two arrays. Why? Because I said to you, as long as price remains within the range of this imbalance and this imbalance, we're neutral. We don't have a drawn liquidity. What would confirm sell side as the draw would be displacement back below this price range here. What would confirm buy side as the draw would be displacement back above this price range here. And because we didn't do that, instead, price went from discount to premium to discount to premium to discount, and then finally displaced outside the range. This is how you trade consolidations, by identifying a discount array that would confirm a sell side idea, identifying a premium array that would confirm a buy side idea, and trade from premium to discount, discount to premium, until we displace outside of that range, and then we can frame fractal market maker models utilizing expansions, retracements, and reversals. This was a screenshot from the mentorship where I said price remains in a sell program after displacing below the BISI, this imbalance here, which is now a reclaimed inverse fair value gap. Why? Well, because at this point here, when price displaced below it for the first time, it became an inverse fair value gap. Price then displaced back above it, forming a reclaimed fair value gap because it's now reclaimed to be utilized as support. Price then displaced back below it again, so it became a reclaimed inverse fair value gap. As long as price remains below this price range, I anticipate previous week low and the daily bullish fair value gap to be reached, which is the first blue box, which is this one here. How we trade there will determine if the consecutive inverse fair value gaps and sell side will be reached, which is this price range here, which is a lot lower. If price invalidates the sell program by displacing above the BISI, this price range here, utilizing that support, I would anticipate a run on Wednesday's high. And so I send this screenshot, if you can see, around here, just before NFP. Notice how objective those scenarios were. I said, as long as we remain below this array, this is the drawn liquidity. If we displace above this array, this is the drawn liquidity, Wednesday's high. There's literally no discretion there. And this is the beauty of understanding and operating within the confines of the algorithm. Because if I know what the algorithm is referring to and what array cannot be invalidated in a buy or sell program, then as long as price doesn't invalidate the buy or sell program, I'm anticipating price reaching my drawn liquidity. Simple as that. And then if price invalidates my idea, I then say, okay, what is the new drawn liquidity? And then identify the invalidation level and repeat the process. Once you can do this, trading becomes very simple because no longer are we focused on relying on ourselves to make money. Now we can just rely on our system and our understanding of the algorithm, and that's where trading becomes really fun. So going into next week, very simple scenarios. This is the array that I'm going to be measuring order flow going forwards. If price displaces above this array, utilize that as supports, then I anticipate this to be a market maker buy model. If, however, price remains below this array, then price remains in a sell program, and we can anticipate further sell sides to be reached. And so for now, very simple scenario. I'm just waiting to see how price will trade in this price range here. If we displace above it, utilize that support. That confirms that buy side is the draw. If we remain below it and fail to displace above it, then that would confirm that further sell sides is the drawn liquidity. Remember, I will update you every single day in the Telegram across all the markets we follow, showcasing the exact scenarios that I'm looking for. And so let's see what the CPI week offers.